Welcome to Ask the Experts, where each week we talk to people in the industry to get the inside word on what's happening right now and what that means for the tactics you should use to make the most of your money. Now, going in to ask for a mortgage is enough to make anyone a little bit sweaty. You kind of feel like, even if you're usually calm and confident, this process feels a bit mysterious. And it can feel like a test that is just too important to fail. So, let's make it a bit less of a sweaty process. Let's find out what they're actually looking for and what you do and don't need to worry about. This week, we've partnered up with Kiwibank, who's kindly lent us their expert, Chelsea Ladbrook.
Before we get into it, Making Sense is stoked to be supported by Kiwibank. We've teamed up to bring you insight directly from their people, the experts who live and breathe this stuff every day. It's not the outdated stuff that worked 5 years ago. It's what's happening right now in the industry to help you make the most of your money. This is making Kiwi better off. This is Kiwi.
Now, Chelsea, thank you so much for coming on, because I know that people freak out about this one. When someone is heading into the bank for that first meeting, hey, we'd quite like a mortgage. Are there certain red and green flags that an advisor is looking for here?
Yeah, absolutely. I suppose some green flags would be kind of your employment history, if it's been steady, if you've had career growth, your income is consistent. So it's not fluctuating, significantly. If you've had good account conduct as well as good credit history, and being mindful of your spending. So those are kind of the main things that we'd have a look at. I do know that last point can be really hard to stick to. I have good weeks and I have bad weeks, but I think it just boils down to actually spending within your means. And if you're doing that, then that's great. Some red flags would probably be, large amounts of debt in comparison to your household income, because this can sometimes just mean that you're overextending yourself financially. And we do have a look at kind of that asset position to see if the amount of debt that you have actually reflects in your asset position. And if it's not, then we're going to start asking questions as to why. Inconsistent income or a history of employment. So if you're chopping and changing jobs all the time, but we can't see any real career growth, as well as poor credit history and account conduct.
That's brilliant. What a good little run through there. So let's dive in a bit more on some of those. When you're talking about the income, good, steady income that's reliable, I think what helps people understand what's underlying a lot of these, right, is you're looking to make sure that someone is a good bet to lend to. At the end of the day, there are rules on the bank that you can't give someone more debt than they can handle. So coming in and saying, what's your income like? Is it reliable? Is it steady? You're basically making sure there that you're giving people an amount of debt that they can keep paying for over the long term, right? Is that sort of a fair summary?
Yeah, absolutely. Absolutely. So we kind of just want to have a look at, see that, us providing you this home loan or, whatever it might be, isn't going to put you into any financial stress. So if we are looking at your application and we can see that your income is fairly inconsistent, like for instance, if you're self-employed and you had a really, really high year last year, but this year it's not looking so good, then we kind of need to know why that is, because we don't want to overextend you and put you in a position where, you can't meet your mortgage repayments and you're defaulting on everything else.
Yeah. And you mentioned there about self-employed. I know I get so many questions from people about this because it is a little stricter for people who are self-employed. That's seen as a bit trickier than if someone's on a salary, right? Can you run me through some of the things that self-employed people should know in order to make themselves a good bet to the bank?
Yeah, absolutely. What we have a look at is we have a look over your past 2 years' financial statements. So things that we're looking out for on there is, if you took a shareholder's salary, what your, gross earnings were, if there was net profit, your kind of cost of sales and things like that, as well as all your expenses. So we want to have a look at all of that to see that, everything's tracking well and that it's going to continue tracking well. We have seen quite a bit actually, over the past couple of years that people's self-employed income can be coming down in comparison to other years just because, we've been sitting within that recession. And basically what we want to know is we just kind of want to have commentary as to why that is and kind of what you're projecting for the next few years. So I'd say, if your income has been down, I don't want that to kind of discourage people from thinking that they're just never going to be able to get a home loan or whatever. We can always try and mitigate those factors. But yeah, I suppose the key thing when getting the home loan with your bank is making sure that your financial statement's all up to date. And that you're having a really, really good conversation with your lender about what next year's going to look like, and if there's been any changes since you last filed.
Yeah. And I think that is a key that a lot of people underrate. It's not that it's just this total tick box exercise, right? It is a conversation, and it is something where I think if people are ready to say, here's what I've got, but also here's why, those whys can also be a really important part of the conversation. I remember when we got the house that we're in currently, it was a little bit of a stretch for us because we were moving to a place where we were building and we wanted to be able to do things like I have my home podcast studio. So it was a little bit tricky. And I was very freshly doing self-employed income. And so I didn't have that full 2-year track history, which is crucial. But what I did instead was I created this spreadsheet. It was just a freaking Excel spreadsheet. But I created this Excel spreadsheet of here are all of the contracts that I've got locked in. Here are all of the things that are booked. It's signed. This is happening. And then here are all of the maybes. And here are the things that might happen. And this is, how far I can forecast out and what the income's looking like. So I had the track history, I had the locked in, and I had the probably. And I laid all of that out. And that was what got us over the line. And if I hadn't been ready to make that case, just looking at the past history wouldn't have been enough. But you've got to have the conversation, right?
Absolutely. And then we do lending like that for so many of our self-employed customers or newly self-employed customers where they don't have that full 2 years history. They might only have 12 months. And what we have a look at is, basically that we want to get, profit and loss statement year to date, as well as know what's on the cards for the next 12 months so that we can actually be able to, use some income and be confident that, we're not putting you into any financial stress and there is going to be some income coming in. So, if you're having a really, really good conversation with your lender or your advisor or whoever, if there's a way to make it work, then they absolutely will try their hardest to.
Yeah. Now, you mentioned before account conduct. And I think a lot of people will hear that and think, what does that mean? So, what does that mean?
So account conduct is, I suppose if you just look at all of your accounts together, so if you've got insurances or power bill payments or credit cards or whatever, that all of that's being paid on time, and that you're not necessarily having any, direct debits bounce or, unarranged overdrafts, things like that. That's what we look at and what we're talking about when we speak about account conduct. What I would say there, though, is if you had had some direct debits bounce because, you just didn't move money over quick enough or, something didn't quite work, you got paid late or whatever, we're not going to hold you to it. We're not going to be like, you've got bad account conduct, no loan for you, We're going to have a chat with you and go, okay, well, that happened, what's going on? And, you give us an explanation and that's awesome. But it's kind of, if we're seeing that it's a consistent problem and you didn't have money in your accounts to be able to meet those payments, then we're going to go, okay, well, possibly you're already overextended, or we need you to work on, sorting out that account conduct over the next 3 months and just making sure everything's getting paid on time. That's basically it.
Yeah, and I'm sure this isn't, a technical bit of advice from your point of view, but one of the things I often say to people that can be a good thing just to show that you've got that good money history is just be a real angel for 3 months before heading into the bank, because that's often the length of time that you guys will look at, right? And you're just trying to show that it's the classic thing of people can be high earners, but also high spenders. And so it's not just about what money you've got coming in, but do you manage it all right? And do you, pay your bills on time? All of this stuff, super important. Again, you're trying to make sure that you're not getting people into debt that's going to get them into trouble. Because the one thing that's worse than not getting a mortgage and not getting into that home is to get it, run into trouble, lose it. That's not a situation anyone wants, including the banks. It's a pain for everyone. So when you're looking at all these account conduct things, it is trying to make sure, even if someone's a high earner, are they managing their money okay? Nicole from our friends at Kiwibank has the inside word on how to get rid of your mortgage years earlier. Sometimes it really is as simple as finding an extra $20 a week and knowing how to put that to work. Want more? Check out the episode from 24th of April, How to Crush Your Mortgage While Rates Are Low. This is making Kiwi better off. This is Kiwi. Afterpay can be a bit of a red flag, can't it? If someone's got, things like these buy now, pay later schemes of any stripe, really, they can be an issue in terms of being a red flag in terms of how people are handling their money. Is that right?
They can be. I understand why people do use things like Afterpay. I know actually probably more people than not love to see that savings in their account. So they'd rather just pay it off interest-free, and have that money sitting there. But they can be a red flag when we can see that it's kind of consistent, Afterpay payments going out, because we would kind of look at that and we would go, okay, but why couldn't you buy that up front? What was the reason as to why you didn't just pay for that? But again, like I said, I can totally understand why people use it, because they want to see that money in their account. It's an interest-free payment. So, I can afford it. Who cares? I'm going to do it. The other thing is that just with Afterpay payments, each bank has, a different policy, how they look at those payments. But it can actually affect your servicing or ability to be able to borrow more if you're consistently using it and there's large payments going out on it, depending on how your bank actually assesses that in the affordability position.
Yeah. And it's funny, isn't it? Because different types of debt can impact the application quite differently. Am I right that student loans aren't really, at least in New Zealand, they're not really too much of a big deal, apart from the fact that obviously you've got to pay for it. And so that's factored into, your expenses week to week. But it's not necessarily a black mark against your application like other forms of debt might be.
Absolutely. Like a student loan, I don't even bat an eyelid at that, that's just more often than not, customers have that, you furthered your studies, awesome, good for you, we're not going to mark you down for it at all.
Yeah.
It does affect your servicing, but I will say that it can affect your servicing because you've got that payment leaving, as opposed to someone who doesn't have it. But yeah, we don't look down on them by any means.
Yeah. Servicing being, of course, how much you can pay back each week, because you've got a certain amount coming in, you've got a certain amount committed to other bills, then how much can go to the mortgage. So when Chelsea's talking about servicing, that is what we're getting there. So what types of debt can be a problem? So we've got student loan, not so bad. It's just, an expense that we have to factor in. Afterpay can be a red flag in terms of, does it show poor money management? What's happening there? Let's check. And then you'd have other sort of high interest debts that might be more of a red flag. Are we thinking things like car loans, what sort of things can be a red flag there? Should people try and pay off debts before they're coming in to ask for a mortgage?
That's a hard question to answer, actually. That's a neither here nor there. I think as New Zealanders or Kiwi, we really love, buying a new car, and, we like new things. So, we see often, customers with car loans or personal loans or whatever. And I wouldn't say it's necessarily a red flag. I think it actually really boils down to that. Are you living within your means, or are you overextending yourself? So, we absolutely see customers who have, bucket loads of debt, which indicates to us that they are spending beyond their means. But we also have customers who, have a personal loan and they want to get a home loan, and, they can afford it. So in that case, no, it wouldn't be a red flag. Yeah.
Okay. What about credit cards, right? Because I think from my point of view, at least, it seems like credit cards are something to just have a strategy around. There's this idea of your debt potential where you're not even in debt yet, but you have obviously this credit limit. You could at any point use that credit limit. So the bank has to factor that in terms of, well, if you did get into debt for that much, how would that impact the mortgage? So what sort of strategy should you have around credit cards and how much does that impact things?
Credit cards, like they can be really awesome if you're using them responsibly. They can help you build up a strong credit history. If you're making your repayments on time, you're keeping within your limits, just things like that. Like they can be a really, really awesome tool. On the other side of that, as you mentioned, if you've got a really large credit limit, it can absolutely affect how much borrowing you can potentially get, because we do look at the total limit that you've got, not what's owing on it. So I have this conversation quite a lot with my customers about, what's the limit on your credit card? And they'll go, oh, it's $20,000, but it's got $1,000 on it. We pay it off each month. I have to account for that full $20,000 limit because, as you said, you can take that whole amount out tomorrow and then you've got to meet the repayments on that full $20,000, not that $1,000 you had last month. So I suppose it's kind of just looking at your credit cards and going, what do I actually need? What do I actually use? If an emergency was to happen, what kind of credit card or what kind of credit limit would I want on that, particular card? And then just making changes from there. When we're assessing your loan as well, like we look through your credit card statements and everything like that, and we'll discuss with you if we think that, you should reduce that credit card limit, or if that's even an option that you want to have a look at, and we'll make changes from there.
How much does the limit impact things? Because I was told it can be sort of reduce how much the bank will lend you by 5 to 6 times. Is that still accurate or has that changed? I know it changes bank by bank as well. So let's just say that it can be different bank by bank. It can be different if the rules change. So this is sort of a rule of thumb sort of moment.
Yeah, I wouldn't know exactly. I wouldn't know exactly like percentages or anything like that. But it absolutely can affect the borrowing capacity like quite significantly. Someone who's got a $3,000 limit as opposed to someone who's got a $20,000 limit. There's such a huge difference there in terms of that minimum monthly payment.
So again, talk to your advisor. It's really good.
Yeah.
So recommend people like having that conversation, because then they'll run you through and you can get these little wins like change your credit card limit, and it can absolutely change things. It's really, really worth just going there for an actual conversation. What about myths? Because I know part of the problem is, as I've just kind of alluded to there, that the rules do change from time to time. So there was this situation only a couple of years ago where we had the CCCFA rules in New Zealand, which were, again, focused on responsible lending, focused on making sure that people weren't overextended. But those rules were super harsh for a while there. And it was really like, think of your strict parents being like, you had Uber Eats terrible, And it wasn't just the banks bringing this up out of nowhere. It was the rules. You guys had to enforce this. That has been really relaxed, changed, I think, much for the better personally. So what is the rules? Are there myths around your spending? Is there anything you'd like to get on the record there of things people think are happening, but they're not?
Absolutely. So there has actually been quite a few changes within that CCCFA space in terms of the winding back of the legislation. The main thing that I think the listeners will care about is discretionary spending. That's all being wound back. So that's how much money you spent on avocado on toast last month. I don't care about that. I do not care. Spend all the money you like.
Thank God.
Within reason. But basically, so that's being wound back. You're like, we used to have to calculate, your TV subscription, so your Netflix, your Disney, all of that had to be factored into the servicing assessment. Your gym memberships, your Reformer Pilates, whatever. We had to include that in the servicing position. However, we now look at that as a discretionary expense, and we go, if the time really hit and, it was crunch time, servicing was getting really, really tight, interest rates were rising, that affordability that you had previously was starting to become really restrained, we know those are the first things that are going to go. So we kind of just apply this common sense approach to it now, which we did do historically. However, for a wee while there, I think it just got a little bit lost and a bit fuzzy.
Yeah. It got quite ridiculously strict for a while. I know it's really important, obviously, to make sure people are only given loans that they can afford. But at the same time, as you say, to have that recognition that if times get really tough, people will change their spending. People aren't stupid. It's nice to have that little bit of leeway, right?
Yeah, absolutely. But also, putting that ownership on your customer as well, and believing that they would make those changes. And more customers than would make those changes, and they'd go, I don't need that Disney Plus membership, or, I don't need whatever.
I want it, but I don't need it.
Yeah. I'm going to use mum and dad's.
Yeah. The classic. I know, it's so annoying that they really track that more. We had a great system going with one person in the extended family having each of the subscriptions, and we had all of them. Not so much now. Really annoying.
Yeah. I'm still tagged on to Dad's Netflix. He pays for the family plan, so
good man. Thank you, Dad.
Yeah, he's on my Disney though.
There we go. See, it all comes around. It's a beautiful circle of life. Thank you so much. That's Chelsea Ladbrook from Kiwibank, giving us the inside word there on what you need to know before you head into the bank to ask for a mortgage. Now, got through heaps of your questions there, but there's always more. So if you do have more questions about this or even anything else to do with money, send them through to me and I will get them in front of an expert for you. You can find me as Frances Cook NZ pretty much everywhere online, but Facebook, Instagram, TikTok, and there's also heaps more money content on there for you. Most importantly though, do subscribe to Making Sense so that you never miss a trick with your money. Until next time, have a great day.
Just a note before you go. This podcast can only give you general information about how things work in most cases. It's not individual financial advice. We're all different, so some of this might not apply to your specific situation. Take what works for you, ignore the rest. If you're after individual financial advice, a financial advisor is always the best bet.